So there are two essay questions on the first exam. You can start writing on the first one now, so we've covered it, but let's just rehash, make sure you're really comfortable with it. So you have to talk about where this industry's come from. This used to be a lot like the property and casualty insurance. They just sold insurance. Life insurance, annuities really were a big part of it. So the main products they sold were term and whole life insurance. Very, very simple products. Very easy to compare one from the other. You just look at the premium. Very, very, very basic, easy to buy products. The problem with the industry was the interest rates rose so much in the 70s. So you got to talk about disintermediation. So what caused this problem for the industry? So disintermediation, first was interest rates, second was the stock market. Make sure you have those two very clearly talked about. So they lost money to banks because people could borrow against their whole life policies that were paying them 3%, and they could put it in a bank CD making, 15% or more. So money was moving from life insurance companies to banks. And then the stock market took off in the 80s. So people were moving money out of life insurance companies, put it in the stock market. So the insurance industry is losing money. What they could have done is they could have just made their whole life policies a little more competitive, but they still would have lost a lot. So what they decided to do is we're going to compete. Now, one thing to talk about when they compete is they're competing from a disadvantage. Life insurance is a much more expensive business model than the investment world or the banking world. Banks don't have actuaries, they don't have underwriters, they don't have claims paying, they don't have lawyers that extent the life insurance company do. So I gave you an example, like a typical mutual fund might charge 0.4%. A life insurance company's expenses are going to be 1.8%. They're going to be 4 or 5 times larger than a typical mutual fund. So they're starting off with a big disadvantage. Probably what I think they should have done is just admit the fact that their industry is shrinking, cut back, stick to what they know, let the industry consolidate. You've seen that with other industries. Their industries, you just don't need them anymore, so they shrink to their capacity. But they didn't do that. Instead, they said, we have one huge advantage. So here's their big disadvantage, is they're more expensive. What was their big advantage? Well, they have two big advantages. They have commissioned sales agents, and they have a tax advantage over the other industries. So how do they take advantage of those two? Well, they take advantage of the sales commissions by making their products so complex, people don't really know what they're buying. If their products are inferior to other industries' products, how do you sell an inferior product? You just make it so complicated. And because you have someone who's sitting there selling it, unlike a bank or mutual fund, you can convince someone it's a good product when it's really not. So the complexity provides incredible asymmetry of information. You didn't have that with whole life and term. The buyer and the seller essentially knew what was going on. The buyer is saying, hey, I need term insurance for the next 10 years. And the seller says, okay, I'll sell you 200,000. It costs you $50 a month. I mean, it's pretty straightforward. And they say, well, I can get it for 40 bucks over here. It's an easy transaction. Now that's not the case. Now the buyer knows a lot more. I mean, the seller, knows a lot more than the buyer. It gives them a huge advantage. And then they've got a hard sell going on from the commissions. And remember, some of these commissions, these expenses are higher even before commissions. And so remember, some of these products we're going to talk about, the equity link products, they may pay 10% commissions. How can you possibly have a competitive product when you're taking 10% of the money up front? So y'all heard my argument on sales commissions. I don't like sales commissions. I think they are going to at least push you toward lesser products just because you're paying the salesperson more to sell these worse products. And then comparison shopping, that's a big one for me. These products are so complex, you cannot compare. I'll show you some examples of that. You can't compare product A to product B to product C from different companies. It's mathematically, practically impossible. Really, the only way to compare these products is through stochastic modeling. You have to run 10,000 scenarios through different interest rates, stock market environments. That's the only way you can compare them. And when you do that, they don't come out very well. You could tell between company A, B, and C who has the better product, but those products compared to simpler products outside the industry look horrible. And then we're going to talk a bit about this with Donya. When they sell the product, they push the tax advantages. And life insurance does have tax advantages. But then when something goes wrong, they say consult your tax attorney. So for some reason, it's okay for them to talk taxes when they sell it, but they're forbidden to talk about taxes after you buy it. So my argument on that is, if you're going to ever possibly tell someone to consult your tax attorney, you better tell them up front that they may need a tax attorney to understand this product because it's so complex. It's very tough. I guess I should have said that explicitly, but it can be very difficult to get out of these complex products. Now, term, we'll talk about term. Term, it's really easy to get out of. If you don't like the company you're with, you just go to another company and buy it again. And we'll talk about that with level term. Then stochastic dominance, this is one point a lot of students completely leave out. So remember these, I hope you're taking good notes because your answer's got to be more than what's on this page. So hopefully you're capturing all this. So because these products are so complex, the only way to compare them is through stochastic analysis, through simulation. If you don't want to know what stochastic means, so just think simulation. And hundreds, thousands of them. So stochastic dominance means when you run these three simulations, they rarely beat the less sophisticated products, the less complex products. And when they do win, the few times they do win, they don't win by much. And I'll actually show you the numbers. We had one firm ran the numbers, and I'll show you. All right. So you got to flesh that out into an answer because it's open book. What that means is I grade much more harshly because I want you to really understand it. I think every one of these points is really important. So don't get fluffy and high level. So make sure it's in your own words. If you've never had me before, come by my office and show me your answer and let's walk through it to make sure. I won't like necessarily get you to an 8+ or 100 or anything, but I'll definitely, if you got a 20% answer, I'll definitely let you know that, boy, you're missing some really big stuff you need to add to it. So I'll keep you from a disaster at least. Some students score really low on these essays. I think some college students have way too many multiple choice exams, and so they prefer for my exams as if it's a multiple choice, but it's not. I want substantive. I read your answer as if this question came up in an interview, and I'm just, how good of a job did you do of really get into the nitty-gritty of details important. So what are you least comfortable with in this whole thing that you'd love to hear? Make sure you do all of it. This is essentially the rubric. I realize there's a little bit of redundancy in the way I listed it up here, but would you bring this up with the life insurance interview? Probably not. This would probably be a little controversial. But in selecting a life insurance company, there's certainly some products we're going to talk about that if they sell those products, it might make you a little bit leery of that insurance company. All right, let's talk about Donya. So I get calls from people who've had financial problems, and almost all of them are life insurance related. I've had a few getting ripped off by financial advisors, paying way too high commissions and those kind of things, but those are easy to fix. But Donya's story, I hinted at it when we started last time, but it's just a perfect example of this. Except she bought a fairly basic product, but she also bought an simplistic product. But her husband passed away early in her life. She had a son she was raising, single mother, very, very low paid jobs. Somehow, I don't know how, she saved up about $100,000, and she gave it all to this one life insurance company. I won't name the company, but if you want to know, I'll tell you 101, but I won't say it on film. It's a very highly respected. It's one of the firms I talked about a couple of classes ago. We were talking about the biggest players. It's a big player. Um, so she turned 70. When you turn 70, these annuities that you've saved up, the deferred annuities, they have to start paying out by law, by tax law. So she had to start paying them out, but the company didn't do that. They were supposed to send her something, reminder of. They didn't do that. And so she goes to her insurance salesperson and says, "What I do, I don't understand this." Well, what he should have done is what we call annuitize it. He should have had her start taking money out. And the IRS is pretty clear on this. If you go to irs.gov, if you have an annuity, they look at your age and they say, you're going to live another 16 years. You got to take 1/16 out, and that will be taxable. That's what she should have done. Guess what the guy did? He surrendered the entire thing. Guess what happened in taxes? 100% taxable, the entire amount of money. And he bought her another annuity. So why did he do that? Any guesses on why he might have done that? You may know the term for that. Have you heard of churning? You get someone out of product by another product, so you get a whole new commission out of it. So you churn them. So what did he do for her? He caused her a $10,000 tax bill, and he got a commission in the process. She could have paid. She may have gotten like a $500 tax bill, but she got a $10,000 tax bill. So she didn't have $10,000. So he had another product with her. She had a universal life insurance product, which she didn't need. She has one son who's a dependent, but he's not a dependent. He's grown up, and so she didn't need life insurance. Why they sold her life insurance, I don't understand. But they sold her a really bad product. So since she didn't have enough money to pay the $10,000 bill, he sold some of that, which caused more taxes for her. So he was just like crushing her all over the place. So she comes to me in tears. She's like, "What do I do? I was going to go visit my son. I haven't seen him in years. He's in Hawaii, and I was going to use that money. Now I don't have any money. So what do I do?" So I wrote a rather angry letter to the company because our ace in the hole was her life insurance rep admitted that he messed up. Because I go back with her. I don't know if I seem intimidating, but I can be. So I go back and I'm as intimidating as can be. This guy's scared to death of me. And he admits in front of me that he messed up. He didn't do what he's supposed to, but he's blamed it on his company. He said they didn't train him well. All right. So that's pretty good. I've heard that. And, so that's what I tell his employer. They ignore it. So I write it again. So one thing you'll know with life insurance companies and property casualty, write a letter to the president of the company. They're called presidential complaints. They have their own department that does nothing but handle presidential complaints. So I did that. And they responded. Their response was, this is when I almost got in trouble at USA because I was almost screaming into the phone. But they said, we'll give the money back to her only because he admitted he made a mistake in front of you. If he hadn't done that, we're not going to give you anything. But because he did that, but to get her money back, she had to sign a waiver that they did nothing wrong on this or anything else they'd ever done for her. That life insurance they sold her, I thought was complete garbage. She had to say that they did nothing wrong on that. That's the only way. So I'm like, I wanted her to sue them because she had a pretty good case. They really messed up. She didn't know what to do. She's asking me for legal advice. What kind of legal advice can I give? None. So I can't do that. But they're going to give her money back. What I'd asked for was actually more than what she lost in taxes, because my concern was if they pay her $10,000, that $10,000 will be taxable. So I asked for 10,000 divided by 1 minus her tax rate to cover taxes on the taxes, whatever. So, and they agreed to pay that back only if she signed this waiver. And so she's saying, what I do, I'm like, I can't give you legal advice. I could tell she just wanted her money. I was tempted to just give her money and then we sue. And if she won the suit, she could pay me back from that. Cause I really thought she had, if you saw her, you would see, this is the person you want on the stands. Their argument was, we don't give tax advice. You should have consulted your tax attorney before he did anything. He gave her tax advice. He sold her annuity, which he shouldn't have done. But they said, now he actually did it without her telling him to do it. So they're telling her, you should have consulted a tax attorney, and then your rep would have messed it up. So it was kind of a really stupid argument. And so I'm screaming on the phone. I actually said, would you do this to your own grandmother? And then I said, I guess you probably would. That's how mad I was at this. I don't usually get that mad. Don't worry. When I get your exams, I'm pretty happy most of the time. But yeah, I was just livid because the sweet little lady had entrusted her entire net worth that she somehow miraculously saved up to this one company, and they ripped her off. So we went to a pro bono lawyer. There's lawyers that give free legal advice to senior citizens. Yeah, you want to guess what his advice was? Anybody? So he's looking at me like, who's this guy? Now he's kind of like, why are you here? So his advice was for her to hire a lawyer. That was our free legal advice. So thank a lot, sir. That's really helpful. So she finally decided to take the money. I wasn't gonna, if I'd encouraged her to go to the court, she didn't want to do that. She just wanted to go see her son. And he actually passed away from cancer a couple of years later. So I met him once. He came and visited, and he was like almost tears in his eyes saying, I'm so glad you're there, because this is an industry. You can imagine her doing this by herself with no background. She would just have been intimidated, and it would have been a disaster. So she took her money. You see that tax advantage thing. This was a very simple one. I talked to some financial planners, and they're like, yeah, man, he really messed up. How could he have been that ignorant? I'm wondering if he was that ignorant, or if he just saw a person who was like, I can mess it up and she won't know, and I'll get a new commission out of it. So that stuff makes me mad. I get those a lot. So I can tell you many other stories. Hers is the one that makes me the maddest. I don't know where she is today. She's probably has passed away because she's moved on after her son passed away. That was so sad. I think it was just tough. But I even did her taxes a couple years just because, I'm a CPA, but I don't do taxes. But for her, I did her taxes. And that's when I figured out, yes, this is not a wealthy person. Now, the products she bought from them, the annuity she bought from them, was actually a pretty decent product. She had that one, not the life insurance. The life insurance was a complete ripoff. But the annuity she purchased from there was a decent product. This firm has decent products. If they had just annuitized it, everything would have been fine. She would have paid a little bit of tax and everything would have been fine. But they completely royally messed her up. So, I don't give advice on stuff like this, but I certainly like people to call me before they buy anything from a life insurance company just to get a second opinion, because this is complicated stuff. It's very, very difficult to understand for a lot of people. And even on the simple cases, you can get ripped off because the incentives are not in your favor. All right. Any other questions on this? I don't know whose toes I've stepped on. None of y'all admitted to working in this industry. And now you all want to work in this industry, right? It is a great industry, and it does do some great things, as we talk, especially with these two wonderful products that are really quite good products that do quite a bit of good. All right, so draft your answers. You probably already have paper one finished, so now you have paper one behind you. Get these essays behind you. Here's another example of a life insurance practices. So you just won the lottery. Where in your list of people you're going to call is your life insurance salespeople? So you now have a lot of money, more money you never need. Any of your dependents have more money you ever need. Is life insurance the first thing that comes to your mind? Probably the last thing. Well, let's read this. What do you buy when you win the lottery? Life insurance. A young, unmarried grocery store worker, no children, so he doesn't need life insurance. Won like $150 million. It's a lot less than that when you make all the adjustments. What did he do? He bought $100 million life insurance policy. Why would you buy life insurance? Don't you want to spend that money on yourself? Why would you buy something that's only going to pay out when you die? That seems kind of crazy. Now he's suing his advisors, along with other investments that encouraged him to assume tens of millions of dollars in debt. I wish this guy had called me. I would have done it all for free. I wish Tim Duncan had called me. Have y'all seen Tim Duncan sued his financial advisor for ripping him off? I wish I'd called Tim Duncan. Hey, I'll take care of everything for free. I'll put you in Vanguard mutual funds. No fees. But Tim Duncan, he's got to worry about basketball. So you're thinking, well, obviously I'm wealthy. I'll just hire the best people in business. They're the most expensive. And then he discovered the most expensive ones are the ones that rip you off the most. Poor guy. He'd be millions of dollars richer if he just called me, and I would have done it for free just so I could say I was doing investing for Tim Duncan, because that would have been pretty cool. Maybe he'd let me sit courtside for one of the championships. This is not just life insurance. It's an industry issue. So he won the lottery, taking a lump sum cash payout. So he got $70 million after taxes. That's not a bad, he should be able to live off of that. He began investing with these two financial advisors who are also attorneys and insurance agents. Boy, you got like the trifecta there. They convinced him to buy 4 policies from 4 companies, telling him he could earn $50 million by the time he was 50 years old. Yeah, this is the tax deferral part of it. We're going to stick this money in these investments that they'll earn tax-free. What they don't tell them is this is life insurance. You're also paying a massive life insurance premium. It's true, you've got a cash value. We'll talk about the cash value. It's growing with investments, and that's tax deferred, and it could even be tax-free, except for you got to die to get it, which means you don't get any of it. But it is growing, but you're paying a massive insurance premium, which means there's no way this can be as good as an investment, because you buy an investment without paying all those massive insurance premiums, you're going to be much, much better off. How they convince them to do this, I don't know. But then I have good friends that bought a very similar product as well. So the agents made $1 million in commissions. That's a pretty good commission, isn't it, off of one sale? They probably took them to a steak dinner or something, they probably spent $50 closing this deal. He knew nothing about life insurance. Oh man, I wish I knew this guy. I would have talked him out of it. He had no need for insurance. He stood no chance to benefit from the policies since he was not named as a beneficiary of the trust. I don't know who was named as a beneficiary of the trust. 2 years later, the defendants attempt to persuade him to exchange his existing life policy for a single $600 million policy. Doesn't even make sense. He learned that his existing policies were highly unsuitable for him and were funded in a way that would provide him no potential benefit and would leave the trust liable for large amounts of gift tax. I mean, they set it up to get the commission. Why did they pick those particular products? Because they had the largest commissions, not because it was in his best interest. He finally surrendered the policies after paying $2 million in premiums. See, that's what I mean. In 2 years, $2 million in premium. He's paying a huge amount, and he's young. What happens to these premiums as he ages? They're going to start increasing. So as young as he is, he's probably very healthy. He's still paying $2 million in life insurance premiums. So even young, healthy people, that's a massive amount. I guess if you do a $600 million policy, it's going to be kind of expensive. So he's seeking damages, breach of fiduciary duty. A lot of life insurance agents don't have fiduciary duties. They have different duties. So I don't know if he won or not. I don't have the answer. How do you protect people like this? So one thing the life insurance industry does have are these look back provisions. So the states say, hey, if you get in one of these policies, and I don't know how long the period is in each state, it can be 10 days, 30 days. If you change your mind, you get all your money back without any questions, no penalty, because these are really complicated products. And so they do let them get out of it. But so listen to your parents. My parents bought the wrong policy. Go and ask them. Are you talking to an insurance agent? Be like my brother is. My brother is not allowed to talk to them without me in the room. He tells them that up front. If you want to use me as a sounding board, say, have your parents call me. And I was like, no, don't buy that policy. One thing that really, really helps is, you got UTSA here. They sell mainly just term and whole life. Find another insurance company and that doesn't have commissions and talk to them about it. They're still going to try to push the sale, but it won't be quite as aggressive. Or talk to someone someone that works in the industry or worked in the industry that has some background, just to make sure you don't step into one of these policies. Because once you step in, you can see this poor guy, Kevin, it's hard to get out of these things. They're a mess. And he ended up, much poorer. You hear all these stories about people buying, winning a lottery. It's like the worst thing that happens in their life. I'm sure he had a lot of new friends after that, but he didn't have any money to give them unless they were named as beneficiaries. Then they're all hoping he dies. So there's nothing in here for him, his good. But they made $1 million in commissions. All right. So how do you pick a good life insurance company? Well, let's go through the products, and that's the article. So let's go to the products. We'll jump to those are notes you can use for paper one. And we'll see that they start from simple to more complex. And what I look at is what are the what's the biggest part of their business that they're selling? If they're selling a bunch of equity linked products, I'm like, I don't know about this company. If they're selling a lot of variable products, I want companies that are selling primarily term and whole life because those are the products that are simplest, most straightforward. So we'll look through them one by one. Life insurance is not insuring against death, it's insurance against premature death. Supposedly, there can only be one claim in a person's life. Unlike property insurance, you can have multiple claims. It's not an indemnity policy. Indemnity policy tries to bring you back to where you were before, like health insurance or auto insurance. So essentially what they're trying to do is replace your human capital. To buy life insurance, the insurance company will require you to have insurable interest most of the time, not 100% of the time, but most of the time. And what they mean by that is that the person buying the policy, the person who's going to benefit, the person dies, they prefer that person be alive than get the insurance premiums and get the insurance payout. So I watch Forensic Files. I used to watch Deadly Women. I don't know why they don't have Deadly Men. I guess Deadly Women is more interesting because women don't commit murder as much as men. But life insurance is a big part of that. I remember these two elderly women, are not so maybe in 50s and 60s, were buying life insurance on these homeless men and then killing them and collecting on the insurance. You know, the insurance, you need an insurable interest. They did not have an insurable interest in these men's lives, which is one reason they got caught. As you see a bunch of homeless men suddenly dying, and then you notice they have a life insurance policy on their life, you're like, the first question the police is going to ask is who's the beneficiary. So that kind of somewhat gave them away. But that's insurable interest. So if you are the insured and the policyholder, it's not an issue. You always have insurable interest on your own life. There's no legal limit. If you want to buy, like that guy did, $600 million of life insurance, there's no legal limit. A company may not sell you that much, but you can certainly go to 20 different companies and build up. So there's no limit. If you buy them much and die in unusual circumstances, they'll probably research it and see. But even then, if it's something illegal not covered by the policy, they'll probably give you your premiums back and just cancel the policy. So they won't even, they'll at least give you your money back. But if you're dead, you don't care. But if the insured and the policy are not the same, insurable interest, this is the only product like this, but insurable interest has to be there when you sell the policy, but not afterwards. This is the only policy like that. Auto insurance, you buy auto insurance, you have insurable interest in the car, you can't transfer that to your neighbor because you and your neighbor are different drivers. So you might have insurable interest in your car and you sell it, you don't have insurable interest. You're just hoping your neighbor's horrible driving teenage kid is going to wreck it so you can collect the insurance. That's not allowed. Once you sell that car, but if a married couple are insuring each other and they get divorced and it's a hostile divorce, they move to different coasts, you can still have insurance on that person, even though you could argue you don't have insurable interest. And that's probably because how complicated these products are from a tax reason. They're hard to get out of, and so they allow you to keep the policy. I had one friend I was helping, her husband that she divorced just was really horrible to her. She had some wealth saved up. He put it all into a life insurance policy, 100% of it, and then made his son the beneficiary. So he essentially stole our money and then he divorced her. The court was so mad about it that they made him change the policy and give it back to her. It was a bad case, but you could argue she'd have insurable interest, but he was able to keep the policy for his son. There's probably some pretty serious court cases involving this. Like I got to remember to get the USAA case on the true, pretty amazing case. I'll find that one here. The consent, usually what the insurance company is definitely going to want is that the person whose life is on the policy, they want their consent. So if it's not the person being insured, even a husband and wife, if a husband is insuring the wife or wife insuring, they want the spouse. So this guy who ripped off his wife, she signed the policy, but she didn't really understand it. And she was telling me just in tears, like, yeah, I didn't know he was doing that. He told me just to do it because he was a very intimidating person. Fortunately, the courts came in and saved her out of that, but it was pretty rough. So they at least want you to sign, but when you sign, you better be aware of what you're signing. I have seen some forensic file cases where it's quite obvious that the signature is forged. There's one case, oh my word, this guy, he found someone who looked as much like him as he could find. And at the last second, this guy, he invited him over to his house to help work on his car. At the last second, this guy bowed out. And so he had to go find someone else really quick. So he found this other guy. He killed the guy, put him under his car, made it look like the car fell on him. Then he set the garage on fire. And then he went and hid. It's people will do incredible things for insurance proceeds. They found him later because the guy, his substitute didn't look enough like him. He's like, how did he shrink 3 inches? So yeah, I would guess probably 10-15% of forensic files cases have life insurance tied to them. So that's usually there. So the insurance company is aware of that. They realize this creates incentives that could be against public policy, and they try to protect themselves. So insurable interest is very important for all insurance. We don't want people having an incentive to burn down their house or to take the life of another person just to get the insurance proceeds. Anti-selection or adverse selection. This is that the people who really need the insurance are more likely to buy it. Sick people are more likely to buy health insurance. People that have some family history of heart disease are more likely to buy life insurance or buy long-term care insurance. That's adverse selection. So the way you handle this is with special mortality tables that adjust for the person's history. If you got a family history of disease, or you're a smoker, don't exercise, whatever, they take all of that in consideration. They have enough data on people to know, hey, you've got these factors. This is the insurance. So they handle it either by raising the premiums or by denying coverage. One or the other they'll do. And so they have to go through that entire process. This is probably on the property casualty side as well, on auto insurance, but I don't think is, that bad drivers buy more auto insurance than good drivers. The problem with that is I don't think most bad drivers know they're bad drivers. So it may not quite work in that situation, but most people know if they're healthy or unhealthy for health insurance and life insurance. Now, on the annuity side, the immediate annuity, where you're going to pay them an income for the rest of their life, yeah, healthy people buy those more than unhealthy people. And the insurance companies don't really underwrite that. They just assume if you buy an annuity, you're healthy. So the fact that you buy annuity, they say you're going to live longer, so they don't give you as much of a benefit. So if you're unhealthy and you buy an annuity, you're probably grossly overpaying for that annuity. Just be aware. I wish they would change that, because I know some people in poor health in their 80s, they're probably going to pass away in a couple of years, but they could live for 5 years. And it'd be kind of nice if the insurance industry took that in consideration, gave them a much higher annuity, just reflecting their poor health. But they don't really underwrite annuities. So unhealthy people just should not buy annuities. We talked about morale hazard. That's the case where buying the insurance makes you riskier. So adverse selection is you're riskier, so you buy the insurance. Moral hazard is you buy the insurance and that makes you riskier. So you buy a car at the dealership, you buy a $90,000 Tesla, you get into it and realize you forgot to buy insurance. So what are you going to do? You're probably going to drive more safely than you ever have in your entire life. If you see another car on the road, you're probably going to pull over and wait. Get it home, you're going to sleep in the car with your pit bull, and you're going to guard it. And then next morning you call State Farm, buy auto insurance. You probably will be a more dangerous driver. This applies to auto. I don't know if it applies to much else. I don't know anyone I can think of that says, hey, I have a health insurance now, let's go bungee jumping. I don't think so, because you got a lot more skin in the game when it comes to your physical body. Or let's, I've got life insurance now, let's go skydiving. I don't think that conversation happens much. But auto insurance, it's there. Auto insurance companies, they just charge you more because you bought you bought auto insurance. I mean, it seems like a scam, but the very fact that you bought auto insurance makes you a riskier driver, so they charge you more. And there's no way to get around that. There's also the moral hazard, which is you intentionally cause a claim to get it. That's the arsonist that burns down the house in order to get the insurance. That's illegal, and you go to jail for that. Have y'all seen some of the videos of people throwing themselves in front of cars? Make it look like they got injured. Some of them are hilarious, especially now with dash cams, because the guy just points at his dash cam and they say, oh, okay, and they walk off, but it's gotten kind of crazy. And then there's crazier people who actually pull in front of an 18-wheeler and slam on the brakes, hoping to get, and some people gotten some big, really damaged doing that. I don't recommend any of that. All right, so these are three important concepts to insurance: insurable interest, anti-selection, moral hazard. The last one doesn't really apply to life insurance, but the others definitely do. All right, so life insurance, the types of life insurance, pretty basic, pretty simple. There's two types. There's term and there's permanent. Term is really one type, but with different lengths of time, and then permanent has a whole bunch of them. It gets really pretty complex. So term is the purest of insurance. It does not have any savings element, which means if you stop paying the premium, that's it, you're done. Permanent insurance has a savings element. So if you stop paying the premium, you have some investment element that you get back. There's some books I found in the UTSA library. I don't know if they're still there. They're very, very old, back from the 40s and 50s, talking about how stupid this savings element is to insurance. If you need life insurance, buy life insurance. Why would you buy life insurance? They say, oh, you know what? We're going to overcharge you, but don't worry. We're going to take the overcharge. We're going to put it into an investment for you. So you'll have life insurance, but you also have this investment. It's like, why would you do that? He kind of said, would you do that with auto insurance? I need auto insurance. What's my premium? Oh, it's $1,500 a month. You're like, you crazy? 15? Well, 500 for the auto insurance, but we're going to take 1,000 of it and put it into an investment for you. You say, well, it's crazy. Well, okay, I guess so. And then you have an accident, and they say, well, the accident was 40,000 bucks, and we paid for most of it with your savings element. You're like, well, you paid for my accident with my money? Yeah, I mean, you had it with us, so we decided we pay for it with your money. That's what life insurance is. So you give them money. If you die, they pay your premium with all that savings they made for you. You're like, well, wait, what? So that's what this textbook was saying, is why would you combine insurance with an investment? Do those separately. Buy the best insurance you can, buy the best investment you can. I do think there's a role for permanent insurance, especially whole life. I think whole life makes a lot of sense. I wish my parents had bought whole life instead of they bought universal life, which I don't like. That would have been a good product for them. We'll talk about that. So I disagree with that author that there's not a role for permanent. I do think whole life makes a lot of sense. We'll talk about that more. These products tend to be bundled. Essentially, you're buying two things at once. You're buying insurance and you're buying an investment combined together. You get huge tax advantages by doing that, but does that offset all the fees? That's the question. So one way to understand these is to look at a chart of the premiums. So let's look at annual term. Annual term is you buy insurance for 1 year. If you die, you get the face. If you don't, that premium's gone. You start over again. That type of insurance is going to get more expensive every year you age. So you can see the premium. I use actual mortality tables to build these. So these are actual numbers. You can see as you age, the term just gets more and more expensive. And when you get up into your 70s, it's just not affordable. The next one is 10-year level term, which I love. This one it's insurance, but it's for you get a fixed premium for 10 years. And then each time you renew it, it gets a little more expensive. So you can see it starts off more expensive than annual term, but ends up less expensive. I'm a huge fan of level term. Most of y'all, that's the level term is what you should buy if you have family and dependents. in your 20s because it's ridiculously cheap and it provides what you need. It can be 20-year term. I don't think they do much 30-year term anymore because of some new regs, but you could buy 20-year term insurance. Whole life or near whole life is you're insured for your entire life. And they're going to charge one premium that whole time. When you're young, that premium is going to be much higher. But as you get older, you got a fixed premium. It's going to be much lower than if you bought annual term. This makes a lot of sense. We'll talk about the forced savings aspect of this. For people who aren't disciplined with their money, whole life can be a great solution to keep them out of serious trouble. And then you can have limit pay whole life. Somebody who says, well, I want to have insurance for my entire life, but I only pay premiums until I turn 65 because then I'll be retired. So that premium is going to be a little bit higher because you're only paying the premium for 45 years or whatever. All right. So you can kind of see, I did a blow up picture here just for a few years. So the annual term is the cheapest initially, but quickly becomes the most expensive. Level term, you got fixed for several years, and it's for most of your working life, it's going to be cheaper than the whole life insurance for most of your life. And then whole life, it's just fixed, and then limit pay where you don't pay premiums your whole life is a little bit higher. So these are actual numbers. I forget how large the premium and how large the insurance was. I should have put that in there. It's probably a $250,000 policy or something. So I'll try to remember next class. Hopefully I remember. I'll log in the UTSA. We can price some of these policies. Let's just see how much it is. And we can compare the whole life to the level term and just see the premiums are quite significantly different. No question. Now these policies, there's no cash value, there's no investment aspect. These, while you're paying in the premium, you are paying for the insurance, but you're also having a little extra amount that's being set aside for you. And essentially what's being set aside, if you make it to 99 or to 100, because they assume everybody dies at 100, when the mortality table I use here, your cash value should equal the face of the policy. So if it's a $100,000 policy, by the time you make 100, there should be $100,000 sitting there. Because everybody that buys whole life is going to get paid. Not everybody that buys term is going to get paid, only the people that die. So that's why the premium is so much lower. All right, any questions on this? Now be real careful on this exam, because I ask for you to put a graph on the exam. It is not this graph. I never ask for this graph on the exam, all right? I have probably 10% of the class puts this graph on the exam, and I can't even grade it because it has nothing to do with the exam question, all right? So put in big, bold, don't put this graph on the exam answer. It's not there anywhere. Maybe later in the class, I'll show you how I built this when we get into the mortality table on price insurance. You'll see how we actually build it. Tax treatment of insurance. Biggest thing is when you die and get a death benefit, that death benefit is not taxable. It's tax-free, and that's huge. That can be really huge. That probably is the single biggest advantage life insurers have over every other industry. That's huge. And the insurance industry has tried to take advantage of that in ways that the IRS said, no, you can't do that. So there are, we'll look at some like Coley and Boley. We'll look at those. Those are life insurance policies that only exist because of the tax code. Bank-owned life insurance, corporate-owned life insurance, trust-owned life insurance, totally, they're entirely tax-driven. There's no other reason for them to exist. So that tax treatment does encourage some gaming of the system. The investment part of life insurance, it can be taxable, but it's deferred. It's not taxable until you cancel the policy and take that cash value out, and then it is taxable. But Congress has looked at life insurance companies that have created some products that obviously were there only for the tax benefit, and they've changed the rules so that those are not allowed. They're called non-MEC and MEC, matured endowment contracts. We'll talk about endowments. I love endowments. I think it's a good product, but what an endowment works, and we'll price one, it's the biggest formula we're going to have. It's the most complicated one to price. But what it says is if it's a 10-year endowment contract, if you die during the 10 years, you get $100,000. And if you're still alive at the end of 10 years, you get $100,000. And what life insurance companies discovered was, whether you live or die for the next 10 years, you're going to get $100,000. So we'll take your premium, we'll invest it. All that's tax deferred. And when you die or don't die, you get $100,000 tax free. It's a way for you to invest. If you do that with young people, most of them won't die. So almost everyone in there is getting tax-free investment returns. The IRS said, no, that's not life insurance. That's an investment. And so they tax it. It's still deferred. So if you make it to 10 years to get your money out at the end, let's say you get 150,000 out, it's still taxed, but it's only taxed at the end. So you still get the deferral of the tax, but you have to pay the tax at the end. So life insurance companies are real careful how to design their products so that they don't fall under these rules. It's just another complexity of these products, but you have to hand it to the insurance industry and say, hey, IRS gives us these benefits. We're going to maximize them. We're going to get the most we can out of them. One warning, though, is there are ways to make life insurance payments, death payments, taxable. So you got to be real careful. One of the most obvious ones is if you're buying life insurance and you're taking a tax deduction for the premium, that's probably going to be taxable when that comes out. So you have to be careful how you structure. Another way people structure life insurance is, let's say you're really wealthy and you're coming to the end of your life and you don't have to pay estate tax and all these taxes at the end, not estate tax, but inheritance tax or whatever. You just buy a bunch of life insurance. So when you die, instead of your wealth being transferred to your family, you have to pay all this tax. Instead, you get it tax-free, but the IRS is not going to let you do that. So there's a lot of rules that the IRS has had to learn. If you want to know why the U.S. tax code is 10 feet tall, it's because people figure out the code and they create new things and have to challenge it. All right, let's talk about term insurance. All right, here's the challenge. What's the shortest period you can think of for term insurance? What's the shortest period you could be insured for life insurance? How long? 1 year. It can be shorter than that. You can be shorter than that. And I don't know if you know what product that is. You don't see it as often as you used to. I'd say 40 minutes is probably the shortest. What would be 40 minutes? So if you go to the airport, they used to have flight insurance. So if you fly from Austin to Dallas, that's probably a 40-minute flight. So yeah, that's about the shortest. I don't know how that is. I haven't seen an insurance. Have y'all seen one in the airport? They used to have these boxes for life insurance, and there's no underwriting because they don't really care if you're healthy or not, right? I mean, the plane, say, hey, if I've been healthier, I would have survived that plane crash. Probably not. They don't really care about your health. So it's very easy insurance for them to sell. It's probably extremely cheap insurance. But yeah, that's the shortest period I can think of. The longest period used to be 30 years, but 30-year term, they changed the accounting rules for 30-year and required companies to set up these massive reserves. So most companies limit themselves to 20. We'll look at USAA and see if 30 is available, but the last time I looked, 20 was the most you could do. So renewable term is you buy insurance for 1 year. At the end of that year, you're guaranteed to renew no matter what your health is, but the premium's going to go up with all the people in your class. So it's going to go up as you age. So if you're unhealthy, you can still renew and your premium won't shoot up because you're unhealthy, but it will shoot up because everybody's aging. So that's that kind of guaranteed right to renew. That right may not last, forever, maybe 5 years, 10 years, but at least for several years, you don't have to prove that you're insurable. So if you have a renewable term and you get really sick at the end of the year, you renew, even though the premium's going up because you're 1 year older, it's not going to shoot up because you're sick because you have that benefit. So there is some protection there if you suddenly get sick. But my favorite of all, which is what all of y'all should buy, is level term. You pay a fixed premium for many years and you're covered for those years. It's ridiculously cheap insurance. Really, really cheap. These are like these $20, $30 policies where you're covered. Makes perfect sense for a young family and make sure just in case something happens, you're not going to really notice it. It's pretty inexpensive. So level term, great policy. Most of them are 10-year level term, but we'll look and see on 20-year level term. Once you get out to 30-year, you're starting to look more like whole life because you're, especially, if a 60-year-old bought 30-year term, it's essentially a whole life. It's the rest of their expected life. Convertible term, we won't talk much about. but usually your employer will provide you with some term insurance for free. Like at USA, I think I got 2 times my salary. It's just part of my employment. If I were to leave USA, I could convert that to another type of insurance, to a permanent type. Most people don't, because generally the only people that convert are the really sick people. And so they're really bad policies. So if you're healthy and you quit your job, you won't even consider this. The only time you look at this, if you're really, really sick, maybe you're quitting the job because you're not very healthy, something's happened. Yeah, you probably should look at the conversion feature. It won't be much, but it'd be better than just nothing. So you look at it. Industrial life, I think, is mainly term. It could be permanent. It's an unusual policy. I don't think it's sold much anymore now with the internet. But this was an extremely expensive insurance because it required a lot of salespeople who would walk around mainly in poorer neighborhoods and sell insurance just to cover funeral costs. So the face amount was really small. The insurance premiums look really low, but they're really large relative to the amount of insurance. In fact, these people would probably be better off buying other types of insurance than buying this. It's just really expensive relative to the benefit you're getting. So it's relatively expensive insurance. I will look at some insurance companies at the end of the semester. You'll see industrial life. I haven't seen many premiums in industrial life, so it's probably a very infrequent policy today. Credit life, I hate credit life, but some of y'all, I just warn you, be careful. But credit life is, if you die before you pay off the mortgage or pay off the car loan, it pays the remaining balance. It's decreasing term insurance because it goes down as you pay off the car or the mortgage. It's usually sold on a group basis. By group basis, what that means is it keeps the paperwork pretty low. So when I was on the board of the credit union at USAA, and we always got requests for this, and I hate this insurance. I said, why are they asking for it? Why don't they just go to our life insurance company and, if they got a 7-year auto loan, just buy a 10-year level term policy. It's going to be cheaper. Why would they buy this? It's going to be cheaper and it's not declining. So you got more insurance for lower premium for 10 years. I didn't understand it, but the president of the credit union was like, but people keep asking for it. And so we went out with a deal with the insurance company, and they did a group policy for us. Any of our customers that asked for it, it would cover that. You're usually better off. I say usually, I don't even think it's usually. You're better off buying regular term insurance. It's less expensive. Also, if you buy level term insurance, when the person passes away, you get the insurance proceeds. They may not want to pay off the mortgage. This person might die and you've got a 4% mortgage, and mortgage rates are 8%. And they can buy a CD paying 7%. Why would you pay off a 4% mortgage? But this forces you to pay off the debt, which may not be your best solution. So just regular term would be the best solution. So the primary beneficiary here, this is why some of you took my P&C class. This is why I hate title insurance so much. It's such a scam. It really, the only beneficiary is the lender. So yeah, if I wouldn't recommend it. If you buy a car, this might come up, and they may actually push it. So there probably are some car dealerships that are maybe getting some benefit out of this, some kind of commission. I don't know. You would think that would be illegal. I only say that because of how hard some of them push this stuff. It's like, why are they pushing it so hard? We didn't push it hard at the credit union. We were just responding to requests. But my answer was just tell them to go buy it somewhere else. So that's term. So I highly recommend, there's my favorite product of all. I highly recommend, if you're going to look for life insurance, you start with level term. Very simple product. One thing I will say on level term, these premiums go up like this. However, mortality, I know mortality's gotten worse in the US because of drug abuse, and especially, I don't even know these, fentanyl. I don't know these things. So whatever that is, I've never had drugs my whole life, so I don't know what I'm missing. But yeah, suicide rates, drug use, but the people outside of those populations, mortality is actually improving significantly. So what you got to be real careful with level term. If you buy a level term policy, don't go to here to renew. Number one is, if you get really sick right here, you're in trouble, because when you're new, you're now sick. What you should do is somewhere around your 6 or 7, look at a new 10-year level term. What some people have discovered is when they get here, they can renew another 10 years and the premium's the same. And some I've actually renewed and the premium is lower. That's how much mortality has improved. So somewhere around year 5, 6 or so, if you can buy a new level term policy at the same premium, you do it because you get all those extra years. You don't have to worry about getting sick during that time. So don't let a level term just sit there for 10 years. You can let it sit there for 5 years, but after 5 or 6 years, start pricing it, especially now that you can price online and quickly get a quote. You'll be surprised. We were seeing this, especially in the 2000s, 2010s. We saw this at UTSA, just mortality is improving so much, insurance premiums are just nosediving, getting cheaper and cheaper and cheaper. And you're sitting here paying this premium, well, you could have come down here and got another 10 years out of it. You might have been able to buy a 20-year that was only slightly higher. So reprice this, don't let it just sit there forever. All right, that's term. So now let's get into permanent. All right, so whole life, the most straightforward is ordinary whole life. When you see the word ordinary, that means two things. And whole life, when you see this, one thing it means ordinary, you're going to pay it, you pay it until you die. If you live to be 90, you're going to keep paying premiums to your 90. And whole life means it's a fixed premium and you're covered your entire life. The premium doesn't change and you're covered your whole life. Now, mortality tables, we'll look at some mortality tables. I used the 1980 table only because the tables got really complicated after that. And we don't want that complication to keep it simple. The new tables go out, I think, to 120 years. They don't actually assume anyone lives to 120, so everybody dies around 105 or so. But they go out to 120 so they can make adjustments just in case that happens. So I haven't used the newer tables. Maybe we should try it, but they go out. They used to just go out to age 100, just assuming everybody dies at 100, and so you're covered till then. So the new whole life, it's possible you're covered to 110. What some companies do is with the old whole life, if you make it to 100, they just pay you the face because they assume you're going to die. That was what the pricing is based on. You might as well get the money if you make it to 100. So it's like a windfall when you turn 100. Limit pay is almost exactly the same, except for the premiums are not for your whole life. They're for whatever period you decide, mainly to when you think you're going to retire, just to save you some money. And you might be surprised, limit pay is not that much more expensive than ordinary whole life just because of time value money. You know, you're front loading those higher premiums. We'll price both of these, but they're really easy to price when you see it. It gets a little complicated. You know how to do present values. All we got to do with present values, we got to add some premium payers in there. And that's not a fixed number because there are fewer premium payers every year because people die. So we're going to make that adjustment. So you're going to do something you hope you don't ever do anywhere else in your life, but you're going to discount people. Have any of y'all done the present value of people? So you're going to discount people because they're paying their premium in the future, but it's probably, these are really easy policies to price. All right, so the first sign of complexity is universal life. And oh, do I hate this product. I used to not mind it so much, and then my mom had this, and I discovered why this was such a horrible product. It was introduced during these high interest rates, and what the insurance company said is, rather than trying to compete on our whole life, let's just create an entire new product, so get new premiums that we can invest at these higher interest rates, and we can pay more competitive interest rates. But this word universal, very, very important. When you see the word universal, what it says is you're giving the policyholder an option. So remember, with permanent insurance, there's the insurance part and there's the savings part. When you see the word universal, what you're telling the policyholder, you have to pay for the insurance part, but you don't have to pay for the savings element. So if your premium's $500 and $100 is for insurance and $400 is for the savings, as long as you pay the $100, you got it. Now your cash value, your investment part won't grow, but you still have the life insurance. All right. So anytime you see universal, think of the word, I have it down here somewhere, unbundled. These are unbundled products. The insurance company is now saying, hey, you have to pay this, but you don't have to pay that. So we talked about disintermediation. So We already talked about this. Yeah, this is what we were talking. So due to that, this product was introduced. It gave them a way to start all over with a complicated product, and it was a very popular product. USAA started selling this. It was their fastest growing permanent insurance policy. The premiums, the cash values, the level of protection can be adjusted more freely than whole life. Whole life, you're buying insurance for your entire life. This is your premium. Nothing changes. It's just fixed. Now, here's the key. This is really, really important. What they pay to your investment part, that can change every month. So for whole life, they have an interest rate they assume. If they don't make that interest rate, the insurance company loses and you win. If they make more than that, they win and you just fix. So for the whole life, they say, hey, we're going to make 4% over the rest of your life. That's the premium is based on. For universal life, the savings element will be paid a different interest rate every month. And they're trying to be more competitive. They want to be current. There's also, the state law requires a minimum amount they have to pay out. Those minimums were as high as 4 or 5% back in the early 80s. Now they're probably as low as 1%. But you had to pay at least a certain minimum. This changes everything. So the first whole life policy I saw, and universal life, sorry. This is what I saw on the front of the ad. That's a little much. If that's on the front of the brochure selling universal life, does this look like life insurance or an investment product? What are they selling here? Life insurance or investments? Where's the life insurance? Universal life, we pay 6%. They never did that before. Whole life it wasn't advertised like this. It now starts feeling like they're in the investment world, not in the insurance world, all of a sudden. And I can say brochure after brochure. What rate are you currently paying? Radically change the rules. So it's unbundled. So COI is the cost of insurance that has to be paid. The rest of the premium does not have to be paid. I don't care about the 2 death benefits. That's not that important, but it just shows there's more bells and whistles. Now with whole life, you could take out money from your whole life at a fixed percent, like 3%. So that's why people are taking money out of whole life at a really low interest rate. They had to pay interest and they put it in a bank CD paying 15%. With universal life, what they're going to charge you for taking your own money out is going to move with interest rates. And it can be much higher. In fact, they actually penalize you for taking your own money out. That's to reduce that disintermediation. So as I said, most of this is sold based on crediting rates. So take this policy here. We pay 6%. Competition, they pay 5%. Which product do you want? Hey, give me 6%. Well, what if their cost of insurance is $150 a month and their COI $70 a month? Now, which product do you want? Not so easy, is it? Pretty complicated to figure out which product would you want. How do you figure that out? Well, what else do we know? Changes every month. Changes every month. Have you ever heard the term bait and switch? Does that sound familiar? Who knows that term, bait and switch? When do you think their rate is really competitive? In the months they're selling the most of their product or in other months? So there's certain seasons when they sell a lot of this. That's when their rate's really high. What if next month their rate jumps down to 4%? Which product do you wish you had purchased? So even though they have the highest rate, that's just right now. Next month, it could be the lowest rate. And there's no rules that They have to keep their rate high. So this is probably the better product. What percentage of retail America can make that decision? And this is one of the simpler complicated products. Do you think 5% of Americans can make a logical choice on this? You don't even know what this is. You can't just do a stochastic model of future interest rates because they can pay whatever they want to. They don't have to pay a market rate. They pay whatever they want to. One thing I liked about USAA is USAA by policy had to be in the top 25%. So at least you knew you were in the top 25%, that you weren't getting ripped off. But you don't have that assurance. They could have changed that policy anytime. They have no requirement to pay you a good interest rate. So it's getting messy. So they can overcharge for the insurance. They can have other expenses. There's all these things they can charge for, but all they advertise is on the interest rate. You know, they can get a lot of policies. This is the first big complexity we have in this product. So I'll give you an exact example here, you know, the cost of insurance or whatever. The other thing they did, and this was illegal. It's called not illegal, but they got sued. And my mom had this problem, but we discovered it too late. I didn't know she had this, or we would have been in that lawsuit too. They call it the vanishing premium. And what they say is, you're going to make so much on that 6% credited rate that at some point you're going to have so much cash value saved up that you can just pay all your future cost of insurance out of that cash value, and you'll have free insurance the rest of your life. Well, they were making these promises when interest rates were 9, 10, 11%. What did interest rates do? They fell down to 5, 4%. So what happened instead was, instead of the cost of insurance going away because you can pay for the cash value, what happened was the cost of insurance overwhelmed the policy, and now they had to take money out of the policy to pay the cost. So let me show you my mom's policy. I don't remember the exact numbers, but this is pretty close. The starting premium, this is total. This is COI and the investment was $250. But that $250 was assuming interest rates would stay really high, but interest rates fell. And so what happened, the cost of insurance goes up every year as the person insured ages. And the person insured was in his 70s and 80s. So his insurance premiums were high. But the amount they're making on savings was falling. So the premium, the minimum COI that we had to pay jumped up $2,500. So my mom comes to me with a universal life policy, and she says, they say the premium's going to jump in January. Say how much? I said, well, they haven't told me, but they said it could be sizable. So my mom, who doesn't have a lot of money, was paying $250 a month, and now to keep the insurance in force, she now has to pay $2,500 a month. Does that sound like a pretty good jump? That's the cost of insurance. Why? Because the cost of insurance was growing much faster, was growing like they thought it was going to grow, but the investment part was not growing fast enough. So eventually the cost of insurance was eating all the investment. She ended up with almost no investment left. The only way to keep the policy in force was to pay the $2,500. What happens to, I think at that point, the insured was 85 years old. What do you think happens to this cost of insurance when the person turns 86? You think it jumps a little or a lot? Well, it jumps quite a bit. So here's what my family had to deal with. We had to look at the person who was insured and decide when that person was going to die. Because if he died tomorrow, we'd want to pay that $2,500. If he lives another 10 years, we're going to pay a lot of money for not much back. What family, do you want your family to have to go through that? You can talk to your loved one. Hey, when do you expect you're going to die? Because we got to make this insurance. If she had bought whole life, what would she have done? Which is what she should have bought. Whole life, she would have paid $300 for life. It would have been more expensive, right? Because it doesn't credit as high of a rate. That would have been a better product for her to buy. Now, why did the sales rep sell her universal life? Why didn't the sales rep sell her whole life? It's a far better product. Any guesses on that? I know y'all know, you just want to say it. So it's commission, right? She got a much larger commission. Why does he get a much larger commission? Because the insurance company makes more money on universal life than it does on whole life. This is the policy she should have bought. If she talked to me, I would have talked to her in the whole life, not the universal life. So there's a lot of lawsuits because of this. People are like, you told me I would stop paying premiums. Instead, you increased my premiums tenfold. My opinion is when they say this, they should run scenarios. What if interest rates fall? What could happen? They should have shown scenarios. They should have told my mom, you know, if interest rates fall, your premium could go from $250 to $2,500 a month. Then my mom wasn't just paying the COI. She was paying the COI and the investment. She was paying everything they told her to pay. And yet her premium still went up tenfold in 1 month. So what I did is I started paying the $2,500 and I told her if the person passes away, you can pay me back from those proceeds. If the person lives too long, then, you know, I'll get what I can back. And unfortunately, I mean, it was sad. The person passed away a couple of years later. So I paid about $40,000 in premiums or something along those lines. And then I got that back from the insurance proceeds, but it was not a fun conversation. We'll talk later about viatical companies. That was my other option. So we'll talk about that. You can sell a policy to another company. In that case, I probably would have gotten about 40,000. So those are the decisions I'm having to make. They'll pay me 40,000. Or I can keep paying the 2,500, and if the person dies, I get 140,000, or my family gets 140,000. Or we let it cancel and get nothing. So we wouldn't do that. We wouldn't cancel the policy. We were either going to sell it to another company, get something out of it because the person that was insured was ill and up in age. So they thought, hey, we can get that money back. So there are options. So the one option you don't want to do is just let the policy cancel. That, especially for anyone over the age of 70, you're going to go and see if you can sell it somewhere else. But that made it more complicated for me. I should show you, maybe one of these days I will. I asked them for all the information, all the scenarios. You would not believe what they mailed to me. It was incomprehensible. It was no PhD in mathematics could have figured out what they sent to me. It was completely incomprehensible. I'm shocked they sent it to me, but it was pretty crazy. My question was, give me an estimate of this cost of insurance over the next 10 years. And they couldn't show me. They couldn't show me that in any logical way. So it was ridiculous. But anyway, just be aware these products, this is the simplest of the complicated products. And you can see how complicated it is. This was my family dealing with it, with me teaching this class and my little brother, an insurance actuary. And we found it complicated to figure it out. So this is not easy products. All right. So do any of your parents have universal life? Do you know? So you might check and see. They probably should have sued their company like 10 years ago. So they probably missed out on that. That's the first thing I did was call a lawyer. My good friend, Walter. Walter, I want to sue this company for vanishing premiums because they were paying out hundreds of millions of dollars. But my parents weren't paying attention. They missed out on that. They could have sued and probably gotten, but it was just too late. No lawyer's going to take it because our policy was so low. We need to be part of a class action suit. Our policy is too small for anyone to take that on. We would have paid more in legal fees. So, all right. This product is the new level of complexity. So we'll get into this a little bit more. Now we're going to add a new word next class, the word variable. We'll talk there. All right. Any questions on anything? So we're talking about the types of products, and when you interview for an insurance company, you won't have a general understanding of these basic products. Life insurance is essentially term and permanent. And with the permanent, this is where all the bells and whistles come in. And most of these products that we're going to talk about now, universal life, variable universal life, equity linked life, these are all products that were developed in the 80s and 90s. A lot of them related to that second disintermediation. We had a strong stock market. The life insurance industry said, how can we sell life insurance but give people access to the stock market? And so they started creating these products. And the first one we'll talk about is not sold much today, but it was a starting point to get into the stock market. And they're called variable life insurance. So Here, the policyholder can say how they want the savings element to be invested versus the insurance, like Universal Life, the insurance company invests the money and then they pay out a spread, minus the spread, what they're earning. But variable life, the policyholder says, yeah, I want the cash value. I'll give money to the cash value, but I want you to put it in the stock market. And so when you see the word, so remember last class we said when you see the word universal, you think unbundled. That is, you have two premiums, cost of insurance and the savings element. With unbundled, you only have to pay the cost of insurance. You don't have to pay the savings element. When you see the word variable, now you're talking about giving the policyholder the right to decide how the money's invested. Stock market, bond money, bond market, stock market. Usually it's a list of mutual funds that they get to pick from, just like with your 401k plan that you'll have. And they decide where that money goes. What happens with this, which is really, really critical, is life insurance is regulated by states. We'll talk about that later. But the federal government regulates investments. And when the life insurance industry issued this policy, variable life, the SEC came in and said, we're going to regulate that. And life insurance says, no, you can't. We're life insurance companies. And there's a famous case we might talk about later where one of the variable life companies was sued by the U.S. government and the U.S. government won. So if you work, this is somewhat the downside of this product. If you work for a company that sells these variable products and you're on the phone, you're going to have to get licensed by the state and by the federal government because this is both a state insurance product and a federal government product. So the federal government consider these to be investments because the policyholder is directing where the investment goes. With Universal Life, it's not an investment because the insurance company is investing the money and paying an amount out. So really, really key variable is the policyholder taking the risk. You must be registered as a broker dealer to sell these. But on this one, you don't see the word Universal Life there, so the premium is fixed. You have to pay the cost of insurance and the savings element. You're not allowed to not pay the savings element. It's an expensive product because now the insurance company is charging its fees and the mutual fund is charging its fees. You've got double fees going on top of each other. It's getting really, really complicated. And then they decided to put the words together, variable universal life. Variable means you can go on the stock market, the policyholder decides, it's still regulated, and universal means they only have to pay the cost of insurance and they don't have to pay the investment part. This became a really, really popular product in the 80s. When I started at UTSA, they just started selling variable universal life. And it lasted about 3 years and they shut it down because it's really hard for UTSA to sell these products. They're very complicated products. You really need a sales agent, a commission agent. UTSA doesn't have commission agents, so they gave up. There's a couple of times UTSA has done that where they started a product and it didn't work. You're really lucky if you bought one of those products because they essentially bribe the customers to cancel the policy. They essentially say, hey, well, give you whatever you want if you let us shut this thing down. It was a mistake for us to do it. So those people actually came out pretty well. I got involved with this product because the woman who was running this product went out on maternity leave. So I took her position. I was her backup while she was out. So I got to see how these things worked and they're interesting. But complicated product. I don't think these are as popular today as the Equity-linked. We'll talk about Equity-linked. We're going to be talking about Equity-linked as an annuity, not as a life insurance, but it's the same type of thing. Equity-linked products are not regulated by the federal government, whereas these are. So we'll talk about the difference in these two products. I just want to bring this up. Susie Orman talks a lot about these products and talking about these complicated life insurance products. It's better to do nothing than something you don't understand. And here she says, raises concerns about a trend where individuals are investing in complex policies. It says such as whole. I don't consider whole life to be a complex product, but universal and variable life are the ones that she probably really meant. Without completely understanding it, she has observed an increase in listener inquiries about life insurance policies. Why? Because they're getting sold these things pretty aggressively. Orman explains that life insurance is generally aimed at younger people who have not yet built substantial wealth. However, the need for such insurance decreases as your financial improves, as your wealth grows. Many are enticed by the appealing, though misleading, idea of benefiting from investment in life insurance simultaneously. And then she goes, I agree with her on this. I don't agree with her everything. You may not even know who she is. I don't even know if she's even around anymore. I think she's still alive, but she got in a little trouble for a product she was pushing where there were some problems with it. So both she and Dave Ramsey have had a little bit of problem in kind of benefiting, saying, warning this industry is going to rip you off, and then them doing something that got them a little bit of trouble. Y'all know Susie Orman? I'm not personally, but y'all know of her? Is she still famous or not? No? Kind of heard of her? The best Susie Orman is Kristen Wiig on Saturday Night Live. She does the best. She does a better Susie Orman than Susie Orman does. It's quite hilarious. So go tonight and do YouTube, do Kristen Wiig, Susie Orman. It is absolutely hilarious if you want to see it. I don't know what Susie Orman thinks about that. But so she's a little bit famous if Saturday Night Live is making fun of her. All right, so that's variable. And then the next one is endowment life. We're going to price endowment life. It's a little bit more complicated. It was created mainly to take advantage of the tax code and the fact that life insurance is tax-free. So the insurance industry said, hey, we can find a way to shield a lot of income from taxes and make it look like life insurance. So there's a pure endowment. A pure endowment is going to get sold so very much, but I'm actually going to show you that I'm a big fan of pure endowments. When I show you my special product I want invented, a pure endowment says you buy the policy, and if you die in the next 10 years, you get nothing. But if you're still alive in 10 years, you get the payout. So that's a pure endowment. You only get the money if you're alive. Most endowments are not pure endowments. Most of them are kind of I don't know what the other word, just endowment life. If you die, you get the face. So if you die next 10 years, you get the face. And if you're still alive at the end of 10 years, you get the face then. So you just don't know when you're going to get the money. And that was what the insurance industry is thinking. Wow, that's really great because not many people are going to die. So most people are going to make it to 10 years and they got all that investment income tax-free because it's a life insurance policy. And the 1984 tax code said, no, you can't do that. The premiums are too large relative to the insurance. This is really not insurance. This is really an investment being tax shielded. But they're still good products because you still get the tax deferral. It's just you get to pay the tax at the end. And then I'll show you a pure endowment and why I think it's so good. We're also going to price joint and survivor life policies. My brother is an actuary, and I said, hey, I want my life insurance class to price a joint policy. He said, no way, you can never do that. And once my little brother says, no way, of course I have to do it. So we're gonna price one of those. It's really not as hard as he thought it was. You can have first to die policies or second to die, usually husband and wife. So first to die would be, okay, these married couple, once one dies, it pays, and the surviving one gets that policy. That makes a lot of sense in a case where maybe one spouse has a pension that goes away when he or she dies. And so you want that life insurance to replace their pension so that the other one isn't destitute. So that's first to die. Second or last to die is usually for people who have estates and they're worried about estate taxes and probate, and they want something for when the second one dies, but it'll pay all of that. We're going to price a first to die policy. And we'll talk some special issues. It can get confusing if it's a husband and wife and they both die in an auto accident. You might say, well, who cares? First to die or second to die. But if they have their own children from different marriages, it can be really important which one died first and which one gets the life insurance, because that has a lot of implications for how the money gets spread to their families. And there have been cases like that, is like trying to figure out in a car accident who died first so they can decide who's getting the proceeds and who's not. So they can get complicated, but first to die, second to die. First to die is probably a little more common and more likely. But we'll price those later. It's not that difficult. Really, you can create whatever you want to create. The actuaries, they can do the math. They may push back if they don't think there's a market for it, but they can do the math. But you're going to see on the second exam, I'm going to create an absolute crazy product that makes no sense. But I just want to see if you can get through the mortality table and do the math. The first time I did it, only one student got the question right, and it wasn't an actuarial student, it was a finance student. So actuary is the pressure zone. After that, 2 or 3 got it one semester, and actuary got it right. And his answer was better than mine. I actually had a typo in my answer. So I actually fixed my answer after I saw his answer. Since then, more people are getting it right because I keep showing more and more examples, and I'm running out of crazy ideas. So it's going to get a little easier. So work a few of them. I think they're great products as it really tests your ability to work through the mortality table and do the present value. So I love it. The actuary is going to love it, but it's a lot of good math. If you understand that, you're really set up to do an interview because it really shows you how life insurance is priced. So some crazy policies. Also, we'll work through 4 or 5 of them in practice, and we'll get a few of them on the YouTube so you can practice as well. So yeah, the pricing side. So it's really a matter of time value money. When the person dies, discount it back to the day, adjust for how many premium payers there are. It's really a pretty straightforward, a lot more straightforward than the property and casualty class. Another thing you'll see is participating policies. So a lot of times whole life, the company will intentionally overcharge because insurance is dangerous. If a lot of people die, they'll intentionally overcharge with the expectation that in the future they'll pay that extra back as a dividend to the policyholder. And the benefit to the policyholders when they get that money back, it's tax-free. It's like a return of premium. Even though a lot of that might actually be investment earnings, it comes back tax-free. So it's actually not a bad deal. Firms that do participating policies, a lot of them take it very, very seriously. The actuary at UTSA, he was absolutely protective of his participating policyholders. He's like, no, we're paying this dividend. And he would have a fight in the committees, but no, they deserve it. We priced it for this. We got this. We made more and we told them we thought we were going to make that goes back. And so he was an advocate. I don't know if other insurance companies were like that, but he was an advocate. He didn't talk much, but when his participating policies came up, he was quite outspoken. So essentially, it's a way for an insurance company to protect itself just in case something really, really bad happens, with the expectation they're probably going to send a lot of that money back. Now, there's a famous company we're actually going to talk about here in a little bit. I'll try not to use their name, but I might. Yeah, I think I will use their name. I'm going to give their name. So this company talked to my brother, and they said anytime you see a participating policy, you're getting ripped off. That was their argument. And their basis or argument is they had an article that said that. And that was their entire basis for that. So here's what they actually said. You can assess what my assessment was. So they told my brother had a policy from State Farm. This was actually a level term policy. So it wasn't a whole life, but it was a level term. The premium was, say, $120 a month, and it was participating. This firm, I call them Primerica, just come up with a name. They said he should cancel that policy because it's participating. We'll give you a level term policy, same policy. The premium, $780 a month, but it's non-participating. And their argument was he should cancel his State Farm policy and buy theirs because participating policies are ripoff. Now, what's the worst case scenario on the State Farm policy? Worst case, he pays $120. That's all he gets. What's the best case? He gets dividends. What's his best and worst case for Primerica? He pays $180. It's absolutely impossible for Primerica to be better. And yet they were telling him he should cancel them. Why? Because an article that said participating policies are a ripoff. I didn't know what to say listening to them. So I just kind of told my brother afterwards that was a really crazy argument. His policy with State Farm was perfectly fine. Now, it's possible that he was 2 years into this, so he's a little bit older, but the premium difference was so big, it's not because of his age. It was just, it's just much higher. So So the question is going to be, if you have a participating policy, but their premium is higher, then you got a problem. We'll talk about that here a little bit. How do you assess that? It gets a little more complicated. So whole life can get a little bit more complicated, even level term. Level term participating, there's a good chance State Farm never paid any dividends on this because they didn't traditionally pay dividends. That was almost just like, maybe we might pay you a little bit. In that case, you just look at the premium. If their premium's lower and it's participating, it's like, yeah, there may be a little icing on the cake there later, but maybe not. So not a strong argument. But the problem with participating policies is one more complexity you've got to bring into this analysis that makes it really hard to compare products. A due asset, is it participating? We used to say par or non-par. Is it participating, non-participating? Whole life, often whole life is participating. It's pretty common for whole life to be participating. So how can you compare two policies? So I'll show you. I'm going to skip the traditional approach because it doesn't really make sense. But there is a way you can compare participating, non-participating policies to try to see which one's better. I'm going to skip the traditional approach and get to the interest adjusted approach. So I don't ask this on an exam because it's not something I really want you to memorize. But what it does is it says, let's look at this policy and let's take in the time value money. So let's look at the dividends this policy has paid. So dividends is money you get back from the dividends you paid. But let's take it to the future value in 3 years using some discount rate, like 5%. So if you took the dividends this policy paid and you did the future value at 5%, you would have had $200 in dividends. At the end of 3 years, your cash value was $2,963. So that's also future value. That's how much investment you have at the end of 3 years. So the total value you received is $3,163. Your premiums on a future value basis were $7,239. So you just take the premiums you pay and you future value them at 5%. So your net cost was $4,000. So you paid $7,000, but you got $200 back in dividends, and you have a cash value of $2,900. We do this on a per 1,000 basis. That way you can compare a $200,000 policy with a $500,000 policy. So on per 1,000. So this is a $100,000 policy. So there's 100,000s and 100,000s. So you divide 4076 by 100, you get 4,076, you get 4076. You then take the present value interest factor of that. So the future value is that, you kind of divide that back in. And so you take the 4076 divided by 12, and sorry, I did it backwards. This is the future value interest factor of the annuity. That's 3.3101. So if you take the 40 and divide it by the 3, you get $12. So essentially this policy, adjusting for premiums, adjusting for the cash value, adjusting for the time value money, is $12 for every $1,000 coverage you get. You can do the same things out 20 years, there where the dividends get much larger, the cash value is much larger, but the premiums are much larger. There, your cost per 1,000 drops all the way down to $746. That $746 you can compare to another company's policy to see which one's better. This top approach is the exact same thing, but without any time value money. And when you don't adjust for time value money, it actually looks like this policy is free, that they're actually paying you to take this policy. If you adjust, you ignore the fact that money has value to it over time. So the traditional approach doesn't really make a lot of sense. So where do you get this information? I don't know where you get it today, but AM Best that I showed y'all previously, that magazine used to publish these statistics for whole life policies, so you could compare. The challenge they had at the time was, do you show actual historical numbers, or do you show prospective numbers that the company's telling you? And they were showing it both ways. And the frustration for where I worked was, we would score really high on the historical numbers, but we wouldn't rank so well on the prospective numbers. But then when you went into the future, we then worked well in the prospective numbers. And what that meant was, some companies are more honest. So some companies are kind of cooking the books, saying they're going to do stuff they didn't do. So back then it was pretty obvious. Don't look at the prospective numbers, look at historical numbers. Trust those companies that have historically had good products. Don't trust companies that say they're gonna have great products going forward. Because it's really common, you know, USA would rank second or third on the history, but then rank 15th or 16th on the prospective. But then when you went out in the future, they went back to the second or third. But I think now it's actually, they don't allow them to do the prospective numbers anymore. The regulators have gotten a little bit tough on companies giving these pretty bogus numbers. But there are ways, but how many people can actually do these calculations? So AM Best will do it for you, and you can look at their screen and look at the histories. But how many people subscribe to AM Best? You know, so it's something that's gonna be tough to do. So just one more complexity that makes life insurance extremely difficult to value. All right, but do remember this: the surrender cost index. It may be useful in assessing products, and AM Best, I wish I could find an AM Best magazine to see if they still publish that on a historical basis. All right, so the first exam has 2 essay questions. You've got one, the ethical one. Are you all ready to look at the second one? So you should have your paper 1 essentially finished, and exam essay on ethics essentially finished. So now you can start working on the second essay question for the exam, so that you're ready. Otherwise, if you wait right before the exam, you're probably going to have to go back and rewatch the entire class. So don't waste class time, start writing your answer. This one's a tough one because I'm not helping you on this one. I loaded the data the way I got it. I'm going to walk through it, but you need to take really, really good notes now. So that you can essentially have a great answer right now if you do it now. If you take scribbly notes, weak notes now, and then try to do this right before the exam, you're going to be in bad shape because it's a mess. I'm going to promise you. Why is it a mess? Well, what the second question asks is, should you buy term or should you buy whole life? That's the question. And that argument came up in the late 70s by a guy named Art Williams. You can look him up. There's a couple Art Williams, but he started Primerica. Yeah, the word gel is in there because he did spend some gel time. Looks like he's still alive. 1942, that makes him what, 80, I guess? 87, 82. He founded Primerica. Any of y'all have relatives working for Primerica? So my first exposure with Primerica was my high school government teacher. He sold for Primerica, so he was selling us life insurance in our high school government class, which is what this company is. What Art Williams discovered was you go find just regular Americans, teachers, firemen, whatever, doctors, and you get them to sell life insurance, and they're really good salesmen. Have you heard of Amway? Some of these multi-level marketing firms, you've seen some of their conferences, and people just going screaming wild, this fervor. That's what Art Williams had with his salespeople. They just believed in Art Williams, they believed in the product, and they sold it pretty tough. He's the one that started it. I don't know his whole history, but doesn't talk. He did have some legal issues where I think he spent some time in jail. But he started Primerica. Now, Primerica itself was an independent company, and then at one point, Travelers Insurance bought Primerica, and then Citibank bought Travelers. But since then, they've all spun up. I think Primerica is all by itself again, but I can't say for sure because they keep changing around. So Art Williams started preaching buy term and invest the difference. So what is he saying? Term premiums are much lower than whole life premiums. So buy the cheaper term and take that difference and put it in your investment portfolio. And he said you'll be better off in the end. That's his argument. So what I did is I went to his webpage at the time, and I brought all of his arguments in for that. And at that time, I did have a textbook I have used in this class, but it's a terrible textbook, so I don't use anymore. But I went to that textbook, and that textbook was very, very biased toward whole life. So I took his arguments for whole life and I put them out there, and I just put them in order, and there's a lot of overlap and repetitiveness. So you got to somehow take this and organize it. So Art Williams is arguing buy term and invest the difference. He created a revolution in the insurance industry. If you brought up Primerica at a typical life insurance company like Prudential or MetLife, you would be in trouble. They hated this firm because he was stealing a lot of their business, and his products weren't all that good. So they didn't like it. They didn't like a company that wasn't that competitive, stealing their business because they had such good salespeople. So for the first time ever, people were having this discussion: why am I buying whole life? It's more expensive. So term was like available just for unique circumstances. Everybody needs whole life. Art Williams turning it on his head. Most people need term. A few people might need whole life. So he's flipping that around. All right, so you are ready for this mix. So you have to take some good notes. Slow me down if you need to get some notes. I don't know if y'all are taking it online or y'all in the notes electronically that you can take notes or write them down. So slow me down if you need more. I'm also going to emphasize the ones I think are most important arguments, because I do think some of their arguments are stronger than others. Which argument do you think I lean toward? Any guesses? You want to know my biases? Term? Yeah, I'm more of a term guy, definitely. So his argument was, first, separate your insurance decisions from your investing and saving decisions. That's kind of like that textbook I told you about I saw in the library. You don't make that combination when you're buying property and casualty insurance or you're buying other type of products. Why would you combine those two very distinct decisions into one product? That doesn't make sense. So separate it. Buy the best insurance you can buy the best investments you can buy. Why combine it into one? The second one is low cost when you're youngest, because your probability of dying is very, very, very low. The insurance is really cheap, so you've got a lot of excess that you can buy. So he's obviously making this argument to young people. He's not making this to 50-year-old, 60-year-old people where the insurance would be pretty expensive. So obviously 2 and 3 are essentially saying the same thing. Obviously, if you buy term, which is much cheaper, and you invest the difference, you can have a lot to invest because you're saving all of that premium. We'll talk about the other side of this. So sometimes I put like a little commentary in there. The problem Art Williams had with the buy term and invest the difference is that Americans bought term and then did what? They spent the difference. About 80-something% of the people who bought his argument bought the term and then didn't invest the difference. They spent the difference. So that's a huge weakness, and it's one of the strongest arguments on the whole life side. It gives you more control over your investment program, but well, are Americans really going to do well on their investment program? How good are Americans? They chase returns, they go in and out. So one of the advantages of whole life, if you lose that control, so you don't make these emotional adjustments moving in and out of stocks. This next argument, I think, is an important one. This one I would think would be an important one. Buy term when you're young, because that's when you need it. That's when you have dependents. That's when you have a spouse and kids that would be pretty serious if something happened to you. And it's the lowest cost. So that's one that I would certainly agree with you. Are you keeping up with me? That's good. The best argument by far is this one. It's simpler. There's really 2 arguments here. Simpler and allows for comparison shopping. You notice this is also part of your ethical discussion. So I have some students that forget to put the comparison shopping, and I'll give them credit. They get it at least in one of them, but I would put them in both of them. So remember, for the ethical side, these products are so complicated you can't do comparison shopping. And I think that creates ethical issues. The advantage of term is that it's very easy comparison shop. You just compare 2 premiums and you take the cheaper one, as long as the companies are viable or not going out of business. So you could make that 2 arguments. The product is simpler. So that's one argument. Because it's simpler, it makes it much easier to do comparison shopping. The next argument, anybody with me? I'm good. Okay, the next argument on his website was, hey, if you need money, you can just take it out of your investment program and you don't mess up your insurance coverage. So he doesn't want you to borrow against your insurance because then you're uninsured. I don't like that argument. We may talk about it when we get to the whole life side. The problem with his argument, I think this is his weakest argument, is it actually can be much, much more tax efficient to borrow from your life insurance policy. What happens when you take money out of your investment program? Taxes, right? So that's an issue, especially if you're in your 401k or something like that. You can borrow against your 401k, but the tax consequences can be much more serious because you have tax penalties. So I don't like that argument. I think it's a weak one, but essentially saying why mess up well, let me go and explain why I don't like the argument of you're underinsured. If you borrow against your insurance, then yeah, you borrow 40,000 and then you die and you get the 200,000, you got to pay the 40,000 back. But if you take it out of your investment portfolio, you're still out to 40,000. So, either way, you're out to 40,000. So I don't really see a big difference in those two. But so I think that's a really weak argument. This next argument, I think this has been changed by the industry. What he's saying is when you buy whole life insurance, the insurance company is not paying you a very competitive rate. You can do much, much better investing on your own. But don't forget, when he wrote this, that was really, really true. Whole life had really horrible rates. But since that time, universal life has come around. And it does pay much better rates. And it's true, it doesn't earn as much as you could in the stock market, but stocks are more risky than what life insurance companies. So he's making a little bit of a risk, not good comparison. So one of the reasons insurance companies pay less than what you can get from a stock fund is because they're lower risk. They're buying bonds. They're not buying stocks. I'm going to argue on the other side that there's a problem with that argument from the other side. And then if you buy whole life, you're buying insurance for after you retire, and you're buying insurance to cover your human capital. You don't have any human capital once you retire. So load up the insurance when you need it. Don't buy insurance over your lifetime so you have insurance when you don't need it. I'm going to argue against that argument as well. But yeah, my main arguments is buy the insurance when you have dependents, when you're young, and buy insurance that you can comparison shop because it's simpler. Those two are by far the strongest arguments. You can see why you need to write this weekend while it's fresh in your mind, because in a few weeks when you do the exam, this can look like you've never seen this before. All right, then the textbook. The textbook was so horrible because it never made the other side of the argument. It only made the industry side of the argument. So he said insurers, yeah, they pay lower rates because these are low risk investments. But the problem with that is we're talking about young people. You're going to do that in paper one. So young people be buying low risk bonds. No, so it'd be in stocks because their human capital is more bond-like. So that argument completely ignores modern portfolio theory that young people should have riskier investments. So you buy life insurance, you're essentially almost 100% fixed income. That doesn't really make sense for a 25-year-old. What if you live too long? Can you get insurance in later years? Well, that's Art Williams' whole argument. If you invest the difference, you'll have plenty of money after you're retired, so you don't need the life insurance. This next argument he made makes no sense at all. He says most individuals can't manage their own portfolio. He's kind of saying you can't buy your own stocks and bonds, but today with mutual funds and ETFs, you can buy the entire U.S. stock market in one transaction. So Vanguard, Fidelity. So hiring an insurance company to manage your money for you is not much different than hiring for a mutual fund. So these two arguments they're a little bit different here. Here he's kind of arguing that you can go out and make really, really good investments, kind of like what Dave Ramsey says, which I really think Dave Ramsey has extremely excessively high expectations out of stocks. I don't think stocks can near make what I've heard him saying like 12%. I don't know anyone thinks stocks are going to make 12% consistently going forward. But the control that you can make, most Americans are not good at that, but they don't need to be good at that. Because if they just go to Vanguard or Fidelity, they can buy a lifestyle fund, put all their money in one fund, and they don't have to worry about that. So you can kind of argue either direction on that one. On the liquidity side, I do think this is a decent argument. For life insurance, you can borrow against the cash value in your policy. You have to pay interest on it, but it's tax-free as long as you pay it back on schedule. It's a completely tax-free transaction. It's a very easy transaction. It's very liquid. I think it's can be a really good way to get money out of your policy. The one thing I think is really strong on this argument is the idea of forced savings. You buy permanent insurance it's not universal, so you don't have a choice between the cost of insurance and the savings amount. You have to pay the whole premium. It forces you to save because you have to pay the whole premium, so you're building that cash value up. So I'll give you some arguments here. Can you replicate that? The problem I'm going to argue here is the life insurance industry has essentially destroyed that argument themselves by offering universal life policies. So that forced savings are going away because now they're telling people, well, you don't have to pay the savings element. So I think they're starting. Now, that's why I love whole life, though. With my mom, I wish she had bought a whole life policy because that would have worked really, really well here. She bought a universal life. She paid the premium every month. Unfortunately, the cost of insurance destroyed it. With whole life, that doesn't happen. Whole life, you're guaranteed a fixed premium your whole life. I think forced savings could work. I know with my parents, if they had an insurance bill to pay, they're going to pay it every month. They weren't going to question it. It's a bill, like any other bill, like the light bill or whatever. So they paid it. And she had that available to her and she needed it. So it turned out to be important that they did that because they were not good savers. If my mom sees someone in need, she gives them all her money. I'm not going to give you her address, but yeah, she's like, oh, I buy them a new car. I just bought them a new house. And then she discovered I had money and then it's like, oh, I can really buy a new house. I was like, wait, Mom. So it's good they had that policy. It certainly helped them. This next one, I do think kind of to my mom's argument, there are many people that are very thankful they had that whole life in their 70s and 80s because they were such bad. It kind of gets back to the forced savings. Because they were such bad savers, that at least they had that. And so for some people, and a lot of people forget they have it. It comes out of their checking account automatically. And suddenly at 70, you're like, what are we going to do? We're out of luck. What if he dies? Oh, we have that policy. Oh, that's right. Oh, that might help us. So for some people, I won't say what percentage, but there are people who definitely are very, very happy they have that policy. But with unbundled and variable products, the insurance industry has really muddied the waters. So I'm down to the point of buy level term or buy whole life, and there's nothing else in the industry. That's my opinion. I don't know if y'all want to invite the guy from my executive MBA class. Y'all want to have a drag out fight in here? I always do that, but no one ever would take me on. I think people are scared of me. Not that I'd win, but that I might punch them or something. I don't really get that mad, but I do get pretty emotional about these issues because this industry has really caused quite a bit of havoc. And you see, I'm not alone. I got Susie Orman, not that she's the best person on my side, but got her on my side. I think Dave Ramsey as well. I'm not a huge Dave Ramsey fan, but what he says about it. Xander Life Insurance. Yeah, that's a video I actually want to watch. So keep it simple if you don't understand the product. We haven't got to the most complicated product yet, which is the equity linked, but these products are increasingly complicated. Variable universal life, it's not that, it's just that it's complicated, but there's no way, I think it's practically impossible to know which product's better than another product. There's just too many things to look at. You'd have to have a pretty massive, Einstein might be able to figure it out if he knew Excel or had Python skills. He could probably write a program to at least figure out which one's marginally better. Right, so that's the first part of the question. Can y'all get that into a logical? So the challenge is, how do you do it? Do you just present all the buy term arguments, then buy whole life argument? Or do you critique as you go? So you say, he also made this argument, I might lead to do that. His first argument is this, second argument is this, his third argument is this. I think this is a weak argument because I might do it in that term. That way I can kind of throw those editorial comments in. When you do that, you're gonna have a little bit of redundancy because you notice some of his arguments, the other side is kind of retorting them. So there's a little bit of redundancy back and forth. So that's the first part of the question. Any comments, questions? Anyone want to argue for variable life?
The argument, the first one for permanent, was saying that they pay lower rate, low risk. Are they arguing that it's lower term? Or are they saying
what they're saying here is the implied rate they're paying in the cash value of the whole life. And that is on whole life, that's set entirely up front because that premium's fixed. And so they set it somewhat low because they don't know what the bond market's going to do the next 30 years. So that's part of it. But they say, yeah, we're not paying you a high return. So whole life does pay lower rates than universal life because universal life, they can change the rate every month. So whole life does pay less, but they say, yeah, but you have no risk. We're giving you a fixed rate. It's fixed in there for your entire, so that premium can never change. So that's part of the argument. But for 20-year-olds, 20-year-olds probably shouldn't be buying whole life as an investment. They should be buying it. My parents bought their whole life, or they bought the universal life, I think in their 50s or 60s. It's kind of expensive at that point, but if they bought whole life, they would have been much, much better off, but it would have had a lower return than universal life. That's why I saw that premium was higher. Whole life might be $300, where universal life may be $250, but at least the 300 can never be anything but 300. And so they will pull some off the investment return to protect themselves from that. On this one, essentially what they're saying is you can borrow against your policy and it doesn't create tax issues. You don't have to call your broker. It is a fairly easy, life insurance companies do make this a fairly easy transaction. Now, I don't know how much of it is electronic now. It probably takes a phone call, but if you call, you'll probably have money in your account pretty quickly. Liquidity might not be the best. I mean, it depends on what your investment portfolio looks like, how liquid that is to get money out, but you might find that life insurance is even faster than the typical investment portfolio. Other questions? Now go figure out what your parents are buying and then have this discussion with them. Or better yet, have this discussion with them right before they buy it, which is what I wish my parents had done, so that you can try to influence them a little bit. I mean, if you knew your parents were about to buy something like this next week, would you want to talk to them now? After just this part of the class, we haven't gotten that far. You probably feel pretty empowered. Say, wait a minute, you might say, email my professor, maybe have a comment, but you probably could handle it on your own by now. You have enough ammunition to make those arguments. All right, one last thing you're going to do on this question is these graphs. This is where I was saying, make sure you use the right graph, right? It's not the graph on premiums. If I can find it. So this essay, you will never use the graphs on page 19 on the essay question. So this essay are the graphs. I still think one or two are going to do it. Students hear graphs and they just go in the notes until they find a graph, and that must be it. But it's the graphs on page 25. So why did I build these graphs? So I had a friend getting married, retiring from the military. I guess he might not have been retired from the military yet, but getting married, and he wanted to buy insurance. And he asked me the question, do I buy whole life or do I buy term? And so I wanted to show him mathematically. He's not a finance person, but he's got a really strong background. He reads a lot on finance, smart guy. So I say, okay, Ken, I'm going to do this. And then once I built this, I'll just show this to my life insurance class. So what you have to do on the exam is draw the graph. Since this is an essay exam, you can't actually copy these graphs into your answer. since you can do your answer in Word, but you have to explain it in your own words. And the notes don't explain it very well. So you're going to have to take really fast notes now. So make sure you're writing all this down, because you have to, this is one of the big weaknesses on the exam, is students do not explain these graphs very well at all. So let's say you're going to buy a $250,000 policy, and it could be a whole life policy, or it could be a 30-year level term policy. And be real careful. What I'm showing you in this graph is the proceeds that you get if you were to die in any. What would you get? What would your estate get if you died in any of these years? So whole life is easy. It's a $250,000 policy. If you die, what do you get? $250,000. That's really easy. So the real key is explaining this orange line. So why does the orange line increase? Well, because the term premium is much smaller, and I do this with real life numbers. The term premium is much smaller. So if the term premium might be $50 a month, but the whole life might be $300, so you got $250 you can invest. Let's assume you invest that at 3%. All right, make sure you get that in your answer. This 3% is how much you're investing, that difference. It has nothing to do with the whole life. All right. So the whole life is embedded in the premium, and that difference in premium is what you're investing. So if you die right here at 45, you get the $250,000 from the term policy, plus you get an extra $50,000 from your investment portfolio that you made over that time. If you die right here, you would get the $250,000 from the policy, plus another 80, 90,000 in your portfolio. So what do you think happens right here? How do you explain this big drop? Not a market crash. We're talking about term versus whole life. What went away right here? Not the human capital. No.
Can you borrow against this?
No. What is this orange line?
Oh, term.
What kind of term? 30 years. How many years is this? So what happened right here? He no longer has life insurance. The policy cancels after 30 years. So if he dies here, how much of the 250 does he get? None of it. Now he is investing more now, because now he's not paying them premium. So instead of investing $250 a month, he's going to invest $300 a month. Right here, what happens? His investment portfolio, even though it's only making 3%, actually is going to get him more than $250,000. All right, make sure you're real clear on that. I'm real picky on the gradient here. So the reason this drops is because the level term comes to its end, and that 250 goes away. If he dies one day later, he gets nothing from the term policy. He still has his portfolio. Well, he's dead. He doesn't get anything, but his estate doesn't get any life insurance, but they still have his portfolio. If he's really sick right here, then that's when you're just hoping, man, can you just, you're going to die in 3 days. Could you just do it today because your policy expires? So life insurance does create these cliffs that can be quite brutal for the family. He's still better off in his later years. So the question is, how important is this life insurance in these years? And he'd have to make that decision. All right.
So the graph, are you saying like at 54, he no longer invests in life insurance? Or he no longer has life insurance?
Well, I'm just assuming he doesn't buy a new policy, because remember, at 54, a 30-year term is going to be pretty expensive. It might be almost as expensive as the whole life, so there wouldn't be anything to invest. He could do that. Instead of investing in a portfolio, his portfolio wouldn't grow as much because he wouldn't be investing as much. He could buy another 30-year term or a whole life at that point, but I'm assuming he doesn't. He has a 30-year term because why? Because all his dependents are going to be moved out of the house by then. He just needs this portfolio.
So the rise is just 3% that he.
Yeah, this is the 3% on the difference in the premium. This is that portfolio plus 3% now on the full premium, because he's not buying any life insurance now. So if the difference in premium is 250, he's investing 250 a month and earning 3%. And then suddenly he's investing 300 a month, making 3%, but he doesn't have any life insurance. What if he could make 6%? Makes a big difference for sure. Here, he's a little bit worse off here, but not radically so. Here's 4%. I guess I should have gone right. Here's 4%. So the key I was telling my friend is there's an embedded investment return in the whole life policy. And you're essentially competing with that as your own investments. If you're pretty sure you can make 5-6%, then you probably should just invest yourself. Here if he dies here, instead of getting 250 from the whole life policy, he'll get like 150 because that's just his portfolio. But because he made 4%, he has a lot more portfolio. And then he's only worse off until about the age 72. He can make 6%. He might as well just buy the term and invest the difference. Because yeah, there's a little bit of difference here, but it's not much. And he's unlikely to die in those particular years anyway. And he's much, much better off if he makes it to 80 or 90, investing the difference. And then I did the break even. The break even was 858. If he can make 858, which you probably can't, even if you did 100% stocks, that's unlikely. But if he did that, his worst case with the term is that he have $250,000. So when the term cancels, that's right when his investment portfolio would hit $250,000. Now, on your exam, you don't have to put all 4 of those graphs in there, but I would put at least 2 of them in there, just so you can explain how important the investment return is. And I'd really encourage you to write this out this week while it's fresh in your mind, because this is not going to make any sense to you at all in 3 weeks. And I count off a lot of points on this because a lot of students just can't remember. Either that or you're going to have to watch this part of the video again when you start preparing the exam question. Ken understood this, and he went with the 30-year, or with the term, which makes a lot of sense. Now, the mark to your point, you could essentially, which could make sense, is do a 20-year term, but in 15 years buy another 20-year term if you're still healthy, and then you essentially get 35 years. There's way, and then you can keep figuring it, look into the premium and see if it's worth it. So this assumes you don't have all those other options. So I kept it pretty simple, but there are other things you can do. This isn't the only choice, but this is the most basic way to compare these 2 policies. And it's essentially what Primerica is saying. They're telling you to do this. He doesn't talk about the fact that if you don't earn enough, why? Because he's going to tell you you're going to make 6-8% because you're going to beat. The problem with Primerica, I can tell you, is the investments they sell are horrible. At the time, my brother saw were horrible investments. High fee mutual funds. So they were selling really bad investments. The other problem with Primerica is their term rates were much higher than the competition. So I would argue buy term and invest the difference, but don't buy term from Primerica if you can find a better product somewhere else. But why do they sell the product? Because they're the ones sitting there in the person's living room talking to them. So they have that captive audience, so they tend to sell. And their salespeople, and remember, my high school government teachers trying to sell me life insurance. That's how aggressive these guys were. They love their job. They love doing this. They got wonderful commissions. If they're getting wonderful commissions, what does that mean? The insurance can't be very competitive because the insurance company is giving a lot of money away to their agents. They can't possibly give that value back to the policyholder. Any questions now? I'd recommend this weekend you write out this part of the essay and then show it to me. Make sure you got it. I won't give you a perfect answer, but I'll definitely let you know if you got a really weak answer somewhere. I could just write out the answer exactly as to be on the exam, but then I'll just be reading my own words over and over again.
Just to clarify, so at 40, where 51, you're going to be making, of course, your 250,000 plus 3%, so you'll be making around 300 or 3% somewhere around there.
Right.
So then once you turn 54, 250,000 goes completely away, but from that 3%, you have about 100,000 saved.
Yeah, I mean it's the $100,000 policy plus an extra 3% plus whatever extra premiums you're putting in because you don't have to pay the premium. Yeah, I mean I set this up with real life numbers. I actually priced the whole life policy, priced the term policy. I used the actual premiums. He had a premium. from, I can't remember if it was from an insurance company or maybe from the military or something. So he had an actual premium. I used that premium in the first analysis, but then I went out and actually priced it using USAA site and using actual numbers for him and his age. So I used his real life numbers, actual real life numbers to give him. I wanted him to have really good numbers. Other questions? We've almost seen the entire exam other than the equity linked annuity. All right, let's start annuities. So that covers life insurance policies. There's a few others that we'll cover later in the class, like key person and Boli, Coley, Toley. There's a few others, but they're unusual ones we'll cover at the very end. All right, so annuities. Remember, with annuities, we use that term very confusingly. Annuities can have an accumulation period and a payout period. Most people, when they think annuity, they think about the payout. I'm going to get a fixed amount of money every month for the rest of my life. To me, the accumulation period is nothing more than you're investing, you're saving for retirement. That's all that is. That part of the product, the accumulation one, can be offered by many different companies. Banks can offer them, investment companies, life insurance companies. Only life insurance companies can do the payout. Banks and investment companies cannot have a product that's contingent for how long you live. So if you buy an annuity from an investment company or from a bank, they're just selling you an investment so you can accumulate money to create a payout new annuity in the future. So if you think in particular, like an individual retirement account, a Roth IRA or a traditional IRA, all these entities can sell those, but those are not annuities. Those are really investment products. So life insurance industry sells both of them, the accumulation and the payout, but they're the only ones that can pay the payout. Now, there are other people that have payout annuities, but they're not companies selling them. So your pension plan, the Social Security, those are essentially payout annuities. They're not life insurance companies, but there are entities that can sell these. So you have to have actuaries to do that because they got to figure out when you're going to die so they can figure out how much they can pay you a month. Now you're studying this on paper one. Why are these things so important? People are living longer, they're retiring earlier, and we got the baby boomer bulge. So you're seeing these in Article 1 a couple of times. Baby boomers is always a big issue. What does someone do? The solution I've had to tell a lot of people is you're not going to retire. Just you don't have enough money to retire. That's not a choice. I spoke to one family. And it was just like you can't retire, and they're like, well, we have special need kids and my health isn't good. I got to get out of this. Like, I'm sorry, there's nothing I could come up with a solution for them. They really didn't have. They're both burned out on their jobs. They want to retire, but they had special need kids that were going to be living with them the rest of their lives. It was just an impossible situation. And they didn't do very good planning. And sometimes on those, I don't have much to say to them. So working longer, and I was at a Subway a few weeks ago, and the woman that helped me, she looked like she was like 85, 86. She was better than any other Subway worker I've seen in a while. Very good worker. But do you want to see her grandmother working at a Subway at 86? Probably. You think she's doing that for fun to get out of the house? She's probably doing it because she needs the money. She was a really good worker, worked hard on her feet all day. I mean, pretty impressive, right? That someone at that age can do that kind of job. But that's what we're going to see a lot of in the next 50 years is people who just cannot retire because they don't have enough money saved up. Social Security, I mean, she probably had Social Security. I looked at the average Social Security for people retired is about $2,200 a month. Can you live off of $2,200 a month? Maybe you could probably cut back some, but it would be a little tough for most people. So annuities, that's what we're going to talk about. What you do with annuities is you get other people to help you. So with annuity, what you're saying, when talking about a payout annuity, what you're going to do there is say, okay, I'm worried about living too long, so I have the people who die too soon subsidize me. That's what annuity is all about. Same thing with life insurance. With life insurance, you can say, hey, if I die too early, I have the people who live too long subsidize me. With annuities, it's the people who die too early subsidize the people who live too long. So you self-insure. It's not the insurance company just stepping in to help you out. You're insuring each other. So it's a pool. So people who die early subsidize people who live longer. You can do retention. You can build a massive portfolio, bet on capital markets. You're talking about that some in your paper one. The average 50-something-year-old, our median has saved up like 70, 80,000 bucks. It's just not much money. You're not going to live very long on that. So yeah, it's just, or you can do nothing and just hope the government will bail you out. There are programs that help elderly that are in dire straits. We don't usually kick people out in the street, but they're not the most pleasant programs. Medicare, especially if you need assisted living, you can get assisted living covered by Medicare, but you have to essentially be dirt poor to get it. You got to eat up all of your assets first, and then you can get some coverage. So this is what you're probably focused in on, but a payout annuity can be pretty good. I usually start with this. I think I told you all this one class. A couple I was working with, they had a couple $100,000 saved up, and they didn't think they had enough for retirement. So I started with annuity. If you bought an annuity, this is your monthly income. Could you live off of that? Just to let them know this is what you have. If that's not enough, let's build up more. But they at least knew, and they're like, well, yeah, that's probably not enough, but it's not horrible. We could survive on that. And that's that plus Social Security. So if you have a couple $100,000 saved up, I'll show you later when we do annuities pricing off of USAA site how much you can get for 300,000. And the older you are, the more you're going to get because they're going to assume you're going to die faster. So you can, at some point, and you're talking about this in the third article, at some point, take some of that portfolio and convert it into a payout annuity, at least give you some baseline for survival. But a lot of people, there is no solution. Like the family I was talking about, retiring is not a solution. They working longer, they didn't want to do that either. So this is why I ask about your parents. You know, this might be the solution. That's always possible. Is that the solution you want your parents to have? Do you want to be raising your parents and your kids at the same time? Your parents are a lot younger than I'm probably thinking, so they're probably not close to retirement yet, but they will be in the next 20 years. So, you know, start having that conversation with them because a very large percentage of Americans are not ready for retirement. All right, so where can they get that? Social Security, it is skewed toward lower income. I was almost going to do the math. So I saw a video by the previous secretary of I forget what he did. So his argument was, it is unfair. The rich are capped on Social Security taxes. Did y'all know that? The tax cap? $168,000. So once you make over 168,000, you don't pay any Social Security over that. And this was Reich. What is his name? Riker? Get his name. He was in the Clinton administration. He was saying that's unfair. Why? He was arguing. So at 168, or say around 170,000, no more Social Security tax. And he was saying that's unfair. They're not paying their fair share. What else is capped for the rich? Where their benefits. So their Social Security benefits are also capped at 170,000. It's not like they stop paying tax at 170, but if their income's 500,000, they get Social Security based on 500,000. So it's capped at 170. What Reich never mentioned that. He just, so I don't know if he was arguing we should keep taxing the rich even over 170, but we should also pay them higher benefits. If he's arguing that, then that doesn't really help the deficit problem because you're just going to pay the rich more money. If he is arguing, take the cap off the tax, but leave the cap on the benefits, what is he arguing? He's just arguing rich to tax the rich, which is fine if that's your argument, but he should have made that argument. I just want to tax the rich more. They can pay more tax for Social Security, but don't give them any more benefits. That's fine. You know, I'm not going to argue against, but he should have made the argument. He never said that. The other thing we know is on Medicare is not capped. So the wealthy making $1 million are paying a massive amount for Medicare. Do wealthy people use more Medicare than the average person? Do they need more to pay more tax? So the wealthy is grossly overpaying for Medicare. And I think they're paying essentially their fair share for Social Security because they're paying for what they're getting. So I don't think his argument works unless you just want to tax the rich. If he did that, it'd be pretty massive. It'd be a huge tax increase. I forget what the payroll tax rate is. As I get the two pieces mixed up. So 765, I forget how much is, okay, so 6.2 is Social Security, 145 is Medicare. So the rich pay the 145 all the way up their income. Now it's only for earned income. It's not taxed on your investment income. So if you make $1 million, you're taxed. So you make $1 million, you're going to pay 14,500. I do that right? Yeah, 14,500 for Medicare. And then Social Security, you're capped at that 170,000 or so. So that's all you pay. It's really more than that because your employer is also paying that. One thing I learned at UTSA on Social Security is the employer is also capped at the 170 unless, this happened at UTSA. I was actually trying to think ways to fix this. If someone that makes $250,000 changes jobs at UTSA mid-year, UTSA no longer has that cap because they worked for one company at UTSA for half the year, another company. At that point, that cap goes away and they have to keep paying. So the wealthy, I think, are paying at least a fair share. I think they're definitely paying their fair share when you include Medicare because a lot of the wealthy, certainly they don't need more Medicare, and a lot of them don't use Medicare anyway. Because when you're wealthy, you probably have your own private doctor and you don't really care about Medicare. So I think they overpay on Medicare. I think they're paying essentially their fair share. But one thing to say on fair share is, first of all, it's skewed toward the poor. So Social Security is skewed so that poor people have a higher return on their Social Security than wealthy people. So that sounds like the rich are overpaying, but what would you think about rich versus poor that might also be important here? Rich tend to what? They tend to live longer. So I'm not really sure Social Security is actually skewed toward the poor. It may be possible, you know, two people, one's rich, one's poor, and they both live to be 90. The poor one will get a higher return on the Social Security than the rich one. But the rich one makes it to 90 and the poor one dies at 67. The rich one did much better. I saw an article once that actually talked about that, and I could have used the numbers to try to do some quick math, but I just never got around to it. So the rich do live longer, so who knows? But if you hear this argument that the rich are not paying their fair share on Social Security because it's capped, always bring up that the benefits are also capped. So I don't buy that argument. So if you argue that and you're not going to increase the cap on the benefits, you just want to tax the rich more, and it would be massive. You know, someone making $1 million, you're taking them an extra $40,000, $50,000 in tax. You're increasing their tax rate. And remember, the employer is also paying that, and that's really part of their benefits. That's part of their compensation. So they're paying an extra $100,000 in tax if you take the cap off. So it's pretty material. You're probably gonna have to soak the rich anyway because our deficits are so huge and they're the only ones with money to pay for it. So eventually you're gonna have to forget fairness and just say, we got to tax the people who have money. So technically it's skewed. So for the lower income, they're essentially getting 60% versus only 30% for richer. It is a pay-as-you-go system. So Social Security is not accumulating the actuarial present value of all the promises they've made. It's pay-as-you-go. It does have a surplus right now, but that will go away. I remember reading, I was reading a book by Franklin Roosevelt. He's the one that pushed Social Security. But Roosevelt said, if you make it pay-as-you-go, it will be bankrupt in 1980, which I thought was an interesting quote because Social Security was bankrupt in 1980, and President Reagan and I forget the guy's name, the Democratic head of the House, they had to come together and they greatly increased Social Security taxes quite dramatically. You should look at the history of Social Security taxes. There was a massive tax increase on the poor and working poor during Reagan's administration for payroll taxes. Huge, huge, huge increase. Mainly to try to keep the thing solvent. So Social Security is there. It's always a competitor to the life insurance industry, but it's probably not enough for most people. Qualified pensions. So I said use this chart in your paper, in your article, in your paper 1, just showing the decline in defined benefit plans and the rapid growth in 401k plans. What's the problem with 401k plans? It's almost the same problem you have with Art Williams. Yeah, invest in 401k plan. A lot of people, especially working poor, they just don't make the contributions to 401k plans. They spend it, they borrow against it. Whereas with the defined benefit plan, you know for sure it's there because your company's putting it aside. You have no control over it. I know many people who were saved in retirement because they had a DB plan. If they had not had done that, they could have never retired. But those things are going away. Most people, these are private sector. Most pension plans today are state employees, government employees, military. Boy, they have a great retirement. They're retired 40 and they got retirement income the rest of their life. That's kind of a nice little retirement. That's not the norm if you work in industry. And then personal savings. So we'll start here and talk about how the life insurance industry can help you with this. Any questions on anything?